Hey there guys, my name is Andrew Taranto and I'm back with you on another video. This is going to be a continuation of my educational series on value investing, and I kind of wanted to get into this a little sooner, but I had a couple issues with my back and a couple other personal issues, so I wasn't able to kind of come at you guys with this as quickly as I wanted, but we're here now, so that's all that really matters. A brief update, I guess, on TRXC, since a lot of the people who kind of are in this channel do definitely follow me on that. TRXC is the stock that my channel kind of focuses a lot on, if this is the first time you're watching it. And just a quick brief update that the stock is going through a bit of a consolidation right now after a historic 70%, meteoric and historic 70% gain just the other day. So a little bit of consolidation efforts, so that just in case you guys haven't heard anything from me, so I did want to bring up my views on that. So with that being said, this is actually a really good time to kind of peel off of that, because I can't tell you how much I hate reviewing stocks daily, because it's madness. That's what it is. It's literal madness to try to review a stock daily, unless some news breaks like had happened the other day, or something actually happens that influences the stock. Growth and decline of the stock on no news days is very, very difficult to predict, and very, very difficult to consider. So with all of that being said, I kind of want to go into what investing is versus what trading is, and understanding the two of them and how they coincide, and how they and the large differences, and what I like to do as an investor, and what I like to do when I enter the market. So a little bit going forward, I want to just look at the overview. So the overview, we're going to talk today about first of all, an introduction. So I'm going to go over a quick introduction, exactly what I'm going to go in, exactly the main concepts that we're going to touch base on in just a moment. And then we're going to talk about Warren Buffett, one of the most famous value investor, I would imagine, since everybody here, I'm sure, knows who Warren Buffett is. And we're going to go over a couple quotes that he said and how they coincide very well with the logic in which I take when I go towards investing. And then we also have the market. And we're going to talk a little bit about the market. We're going to talk a little bit about rational and irrational theories, and we're going to talk a little bit about fear and greed, and price. So, and then afterwards, we're going to talk a little bit about the difference between investing versus trading. So we have a lot to get into, so I'm not going to go on too many tangents or side convos, just because I do want to keep this largely educational and moving. So definitely let me know, obviously, whether or not I'm doing a good job at that. And also, and I know I just said I wouldn't get into a side tangent, but I did want to go ahead and give a shout out to all the new subscribers and those who are staying subscribed. Really appreciate all your support. Okay, so going forward, I want to go into a quick brief introduction. I want to read off this quote right at the bottom. This is a Warren Buffett quote. He says, "We shouldn't care if the market is open or closed." And we really shouldn't, because as an investor, remember, when you're investing, you're not looking at a stock. You're not investing in a number to go up. That's not what you're investing in. When you're investing, you're not saying, oh, okay, it's $2 today and it went up 25%, so now it's $2.50. What do I, what's my MO? What am I trying to, is it the stock that went up 50%, or is it the company that went 50%? Now, more often than not, we see the stock. So we look at the stock and we say, oh, the stock went up 50%. If I owned X amount of this shares, it'd be this much more profitable, and that's good. Which it isn't, because it could go up 50%, right? Or 25%, whatever, and then just tank into the absolute ground. Right, because it's not a good company, and maybe it was a quick pump and dump, and we saw a lot of those during last year, and we'll continue to see those. And that's actually where a lot of traders can get caught. They can get caught at the top of a mountain where they think they're going to buy, at 25% up, and hope to make a profit, which is just, it's not really good thinking. I mean, obviously, yes, crazy things can happen, but crazy things don't happen randomly, and especially with TRXC. I was following them since 65 cents. You can see on my channel. None of that to me was crazy. None of what's happening right now is crazy. None of these things are abnormal, something I didn't already predict or expect to have happen. So when I invest, I'm not investing with the idea that it might, go up 70% tomorrow and that's why I'm investing. No, I'm investing because I think it's a great company. I think there's a lot that to be said and a lot to be done with the company. So with that being said, we shouldn't care if the market is open or closed, because the market is a avenue of prices and stocks. It is an imperfect realization of a value of a company, and a lot of the times that value is distorted and irrational. A lot of the times the value of a company is not where it should be. And that's why we see these meteoric rises where things can jump up all of a sudden because people are realizing quickly, or when things get attention, that the value of the company has gone up. So with that being said, I do want to kind of hop into the first topic, which is kind of like solidifying what I'm going into here, which is with Warren Buffett. And Warren Buffett is one of the most popular value investor. Maybe not the most popular investor, but certainly very well known. If you like him, you like him. If you hate him, you hate him. But Warren Buffett did an excellent job in terms of understanding how to find companies on sale. And he says this in this quote, he says, "Price is what you pay, value is what you get." So with that being said, we have to really go back to what I was saying before, that if price is what you pay, value is what you get, then why should the market matter, right? So if I know something's valuable and it's going to grow, I'm going to pay the appropriate price for it, because I'll know that this company has value and it's going to, be something that's worth investing in, and we can take that investment into anything. Into any sort of element of life, whether or not you're buying a purchase, a dog, a cat, a car, a house, your children, whatever it is that you spend money on or you invest in, you really have to, yes, obviously there's a human aspect to this, and we can't be stone cold rational beings with every facet of our life. And sometimes, yes, we buy things that have zero value, or we do things that don't have value, and that's okay. That's not a problem. But what's important to remember is that with the stock market is that's a place where we should be a little bit rational. We should get rid of all of our irrationality. Maybe don't take that into all facets of life, although I think that it would be somewhat beneficial to some people, who, especially the people who buy things they don't need or do a lot of activities they don't need to be doing. Realizing, going to a $10 gym membership and working the same equipment doesn't really change what your body's going to look like. Obviously, there's certain preferences that people have, and there's certain reasons why people need to do things, but you always have to be able to equate that to a certain amount of value. And when you start thinking like that, and you start thinking like that regularly, you'll start looking at companies a lot faster and a lot better, because you'll start looking at them as value and not as just stock numbers that you think that you're looking at charts and trying to predict patterns, which is what half of the world does. I hate this. One of my least favorite things is to go on YouTube and I watch a video and it's just some dude just going over. That's why I hate the chart videos. And I look at the charts just because I know a lot of you guys really care about them. But perfectly honest with you, I don't really care what the chart's doing. I look at the chart a little bit just to get a good understanding as to the consolidation efforts, and maybe a time to buy, maybe a time to kind of get myself involved. But I don't necessarily look at the charts because I'm trying to predict the movement. I'm sorry, but there's a lot of people who will look, especially in the Weeble comment section comedy. It's like you're looking at RSIs, you're looking at all these, moving day averages. Stop. It's not, stop. Just stop. That's such a weird use of your time. It's none of it's founded. I mean, sure, there's certain elements that you could say some people made lots of money off of, but We're going to go into exactly how profitable day traders truly are using these methods, and staying away from what I do, which is, investing into the company, not investing into a chart or a trend or, whatever a mathematical, equation that you somehow have figured is the end all be all that this stock is going to go up, when we don't know it. An offering can happen, freak things can happen, news can break, and understanding what the catalysts are for the stock's growth and the milestones it needs to achieve is very paramount in knowing exactly how you should invest and what risk tolerance you should take on. Okay, so with all that being said, I kind of want to go into what the market is. So the market acts as a buy and sell feature. You can go into a company, you can go into the market, right? You can go into the market and you can somewhat understand what you're doing in the market very simply, right? I'm buying a company and then I'm selling a company. I'm buying a company and then I'm selling a company. And that's really what you're doing when you get yourself involved in the stock market, right? You're essentially buying and selling companies or stocks, or technically companies, yeah. So, because a piece of a company. So with all that being said, if I know I'm buying and selling a company, then I really have to ask myself, is this market in which I'm in, is it rational or is it irrational? In other words, if I go to a store and I buy an item, that price has been rationally, came to, with factors of inflation, profits, what the price is, how much it costs to make it. All the things have been kind of calculated to make a price that's it's a good mid price, not too high, not too low for the seller, not too high for the buyer, and that's the price it's at. Obviously, things can change as maybe the value of the product goes up, or sales are going down, or whatever the case may be. So when we think about the market and we think about the market that we're in, we have to imagine it to be, basically ran by other people. Everybody else in the market is a human being. Every share you buy is from somebody who sold it, somebody who's selling that share. So we have to imagine that this is full of irrational people, because for every time you think you're making a rational decision, someone's making an irrational decision. The second you think you should buy, someone is selling. So you have to be aware of that it is an extremely irrational force. It's mob rule. So things can get very out of control very quickly. So with all that being said, there's two main emotions that people have when they're in the market. And these emotions are what makes it such an irrational thing, because we have certain ideas, right? So obviously there's certain things that are priced pretty well, right, in the market. There's certain things that in the market, when we look at them, we're like, oh, okay, that's not too bad. Yeah, it looks like about right. And it's possible that there was a rational understanding of what that company should be worth. But we can't just look at it and say that, because there's tons of factors that are going to be incorporated into understanding whether or not something is irrational or not. And those factors include the industry they're in, the various ratios in which they have from a financial standpoint, their balance sheets, news, press releases, insiders. So many other factors go and get involved, and most people who invest or trade do not look at it like that. They don't go, or most people who trade especially, definitely don't go through every little aspect of a company before trading. What they'll see is they'll see something's up a little bit, they'll see a little bit of a trend, and they'll draw an arrow and say, oh, that's it, it's good to go, and then, buy in. And sometimes these do work out. Sometimes we do see, that it does work out, and that's the unfortunate part, is that it does sometimes work out, which kind of feeds into this mindset that trading stocks based off of just patterns is a reasonable way to do it, and not even look once into what the company actually is. So with that being said, the market runs on two emotions. Those emotions are greed and fear. Now I write here that greed creates prices that do not correlate with value and any price that exceeds the appropriate value. So with that, being said, is greed is going to create prices that, go above what the price should be. Okay? And when we know what the appropriate value is, and that requires making a price target and looking at a bunch of numbers, and I don't necessarily want to go into that right now. I want this to be more of a theory-based video. The fact that once you know that it's above that value that you have, prescribed it, we can kind of, look at that as greed. Now, let's say the value of a company you put at $6 a share, and it's currently trading at $3 a share, but it just went up 70%. Right? Now, if I put my price target at $6 a share and it's at $3, but it just went up 70%, would it make sense to sell there? No, because you're still selling into fear. Fear is actually the motivation that you're selling into. You're not selling into greed, and be aware of that. And then the other aspect is fear, and fear is basically any price that does not exceed the value or is below the current value. So look at it like this, well, I think the stock should be worth $3. How much is it? It's worth $1. There might be a little bit of fear in there. Maybe buy that up. So that puts you in a position now to understand what the elements are. And we can look and see through downward movements in charts and whatnot. And that's really the only thing I really use charts to kind of see what the history was from a standpoint of price movement. We can see, and what events caused it, we can see that this a downward sloping company can kind of represent a very fearful attitude towards the health of the stock, and that can create extremely undervalued companies, whereas greed can create incredibly overvalued companies and companies that are expected to perform far better than they ever could. So going forward, let's talk a little bit about this slide I like a lot. So this one kind of comes right at the day traders' throats, and I've been sort of doing it almost this whole presentation, but I guess I'll do it a little bit more openly now. Only 3% of day traders are profitable. That means 97% of people who day trade stocks on the stock market end up losing money, or end up just breaking even, whatever the case may be. So I write here, before you consider that value investing is not nearly as lucrative as day trading, studies do show that only 3% of people who actually trade stocks daily make a profit. And with that being said, we really have to be aware of that, and we have to ask ourselves, why is that number so low? The number is so low because they're gambling. Day traders are gambling. They're just going to a stock that happens to be moving up. And funny story, I actually used to be a day trader. I used to be that type of mindset where I would just look to buy stocks willy-nilly. Just, let me buy this one, buy that one, buy this one, buy that one, without any real, understanding. And yes, I made some money, but I didn't do as well as I think I probably should have, given had I invested it differently. Because I did make some money off of a day trade with U1K. Knew nothing about the company. I just knew it was a black media group. So it's like a black owned business. And this was happening right during the George Floyd death and all of the riots. And it was, such a profitable investment because people pumped money into that company. And that required, very little research. I didn't look into that, but I got lucky. And I could think somebody might see that and say, why go through all this hassle when I could just do this and make all this money? Well, you go through the hassle because chances are you're not right, or chances are, that doesn't happen. And you have to be aware of how lucky you really are when good things do happen. And that requires, obviously, research. So going forward, this is kind of like my 4 steps on how to invest that I like to do is find a company. This is probably your most important part, is finding the company, finding something that is undervalued, finding something that you can get in at a great price at, and finding something that looks like it's going to grow. and CEO with integrity, margin of safety. Now wait for the price. So waiting for a price is, very pivotal too. A lot of value investors will sit in cash. They'll just absolutely sit in cash for a very long time, just until they can find something worth buying up. And then afterwards, we're looking at finding a price target. So when you look for a price target, you have to be kind of cognizant of a lot of different factors, and I will go into that. I'm gonna make a video actually how to find a price target. I'll make a video just on that, and that's gonna kind of go into a few mathematical numbers, PB ratios, and understanding multipliers and what private versus public equity and how those two coincide with each other and why one's more expensive than the other. And then we have to sell at a price. So once we find our price target, we find where it's supposed to be, and now it's time to sell. So, understanding that, yes, there is always the risk of losing potential profit, but I would always rather take the risk of losing potential profit when I know that my price target has been hit due to my own research, than selling at a price far below it, where now I'm now losing money. Especially if I made a good investment. It's very upsetting. So with all that being said, I think you guys have a pretty fundamental understanding between the differences of investing versus trading. Investing is essentially buying a company, whereas trading is buying a stock. And the differences between that are very clear when it comes to not only profitability, but it also comes to the ability for people to for you yourself to actually make some money off of your investment is going to come from getting into great companies at a great price. And if you can consistently do that, I promise you'll be extremely wealthy in the market. All right, with all that being said, thank you so much for stopping by, and thank you to all the new subscribers. I appreciate you. All right, I hope you guys have a great rest of your day and a great rest of your night. All right, bye-bye.